Today we're looking at the Schwab US Broad Market ETF, SCHB. We'll look at how much dividend income it provides each year, dividend yield, payment frequency, total performance, and the management fee. SCHB is an ETF provided by Charles Schwab, who own and operate the fund. Charles Schwab are the ones who own the underlying shares in each of the individual companies. So when we buy shares in the ETF, we buy from Charles Schwab, who continually issue new units in an open-end fund and not the individual companies inside the ETF. SCHB tracks the performance of the Dow Jones US Broad Stock Market Index before fees, expenses, and tax. The ETF provides a low-cost exposure to large-cap companies in leading industries of the US economy. This ETF suits buy and hold investors, primarily seeking long-term capital growth with some dividend income. It pays distributions, which are dividends from the ETF, 4 times a year, with a yield of 1.23%, which would equate to $1,230 of dividend income for every $100,000 invested. It has a management expense ratio of 0.03% per year, so for every $100,000 invested, it will cost $30 per year in fees. This is automatically subtracted from the unit ETF price, so you won't actually see any fees being taken out of your brokerage account. Since SCHB tracks the US markets, it is concentrated towards technology companies. The largest portion of the fund, at 30%, is in tech, followed by financials at 13.5% and healthcare at 12%. Materials, utilities, and real estate companies make up the smallest percentage of the fund, under 3% each. The benefit of investing in US stocks are the historical outperformance long-term over broader indexes and other countries. It also has a larger market breadth, covering a wide range of American industries and instant diversification, reducing the impacts of specific industries or companies. The bulk of the US stock market returns have come from capital gains, and with dividend reinvestment, this leads to larger compounding growth over time. Since inception, SCHB has had an average annualized return of 14%, which includes both capital growth and dividends. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative returns become much better. Reinvesting these dividends creates a larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the sort of approach I take investing for the very long term using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.